Hi everyone, my name is John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that the risk in trading options can be substantial, so make sure you are aware of all your risks prior to placing any trades. Also note that in the presentation, we're using a hypothetical computer simulated trade. The results are believed to be as accurately represented as possible, but keep in mind that live results can vary for many different reasons. So, if this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC. And myself and my team are here to help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment, we're going to be going over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than solely depending on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time, but it does mean the probabilities of us winning are much higher than they might be otherwise. Now, when you find that you're looking for more information, as you're following along, simply contact us at lockeinyoursuccess.com. That's L-O-C-K-E inyoursuccess.com, or ask a question in the comments on this video, and we can direct you to where you can find more information. Okay, let's move on. The winning trade we're looking at today is called a bearish butterfly. Now, the bearish butterfly is one of three primary trading structures we utilize on the more advanced rock trading system. And this bearish butterfly is designed to maximize results in very choppy and more bearish market conditions. So it'll take advantage of a variety of markets, such as overextended uptrending markets, volatile or very volatile sideways markets, as well as volatile downtrending markets and smooth downtrending markets, which is essentially most of the time. The trade itself requires a minimum capital of $5,000 per trade. However, our example today is going to be a little larger than that. It's going to be $50,000 planned capital trade size. For those of you who are not familiar with the term planned capital is the maximum amount we're expected to get in a trade. A $50,000 trade size in this case is going to be what we call a 10 lot, or 10 times the size of our minimum size trade. So the profit target on this strategy is 30% of our planned capital, which in this case would be $15,000. The trade also has a reduced profit target number should the trade get 21 days to expiration or closer. And the exit loss trigger on the position, or stop loss as some people might call it, would be 30% of our planned capital, which is $15,000 as well. So let's take a look at the trade. So this is what a bearish butterfly looks like upon entry. Now this is a February expiration. If you haven't seen one of these analytical graphs before, or this analytical software, this is a software called Option View. It shows us our options expiring in various months. This is our January expiration, our February expiration, our March expiration. These are the strikes that are available to buy and sell, the option strikes. And this tells us how far from expiration we are. We're 56 days to expiration. That's when this trade begins. There's no formal setup for entering the trade, although this could be traded as an opportunistic trade when the market's overextended and so forth. It could also be just simply traded monthly, entered 56 days to expiration as a monthly income trade. And that's how we're demonstrating it here. We're not really paying any attention to what's going on in the technicals. So this particular strategy, like I said, starts 56 days to expiration, and it goes till it either hits one of its profit targets or it max losses out or expires. So here is our entry position. We're going to put on a butterfly that's somewhere between 10 and 30 points below the market. And in this case here, we're putting on, or we're selling 20 of our 660 short strikes. We're buying 10 of our 1710 long strikes and 10 1610 put strikes. This formation is referred to as a butterfly. If we look at this on an analyzed graph, or what we call a risk graph, the risk graph tells us our profit and loss on the left side here. It tells us the asset price along the bottom. We have what we call an expiration line, which is the bright red line. and that tells us the value of the position should we take it to expiration at any given price point, as it currently is. And this dashed or dark red line here is what we call our T+0 line. That tells us the projected value of our position at any given price point as of today. And we can add more lines in here too for future dates. So over time here, this trade, if the market does not move at all, is going to gain in value. In other words, this dash line is going to go towards the red line. That's assuming it's under the tent. Gets outside the tent, of course, the opposite will happen. As things go along, this is going to get adjusted or added into. So a bearish butterfly is what we call a scaling in negative delta trade, meaning if the market goes up, we're going to increase our position size. If you notice, we're running a planned capital of $50,000. Our current capital on entry is only about 10. If the market goes up substantially, we may get into the $50,000 range with this position. If the market goes down, generally we're going to end up taking money out of the position. It's going to get less and less money in the position. So from here, as I was saying, if the market does go up, we're going to be scaling into more butterflies. If it goes down, what we do is we're essentially going to roll this butterfly back. We're going to take it off and move it back. This particular strategy has one set of rules from entry to 21 days to expiration, has another set of rules from 21 days to expiration into expiration if the trade requires going that far. Now, this is called a bearish butterfly, and that is because it's designed to take advantage or be a little bit protective in our down moves. And it's going to handle down moves better than many or most other strategies. And that gives it a little bit of a vulnerability if you get these really, really long extended up moves that are very, very large. That's when the trade tends to take a loss. Other than that, it wins most of the time. So let's get going. Let's see how this trade goes along. We will look at the charts just for giggles. We are in an overextended market right now. You can see the Russell's just come off a very long up range, so this happens to be a good entry. And we're currently sitting here at what we call minus 65 delta. That's essentially saying if the asset price goes up, it's projected that if it goes up $1, this position is projected to lose $65. If it goes down $1, it's projected to gain $65. We have our theta number, which estimates that the position is going to gain $83 a day if it sits in this position. And then we have what we call a Vega number, which is related to implied volatility. And it's implying that if implied volatility goes up a point, it's going to lose $628. If it goes down a point, it's going to gain $628. These are just estimated projections, and they don't always work out that way. As you'll see, if we continue to watch the winning trade series, there's times when we gain a lot more than that, or we may lose more than that, or they don't follow the model, but that's what it's projected to do. So let's just go to our first adjustment. So the entry was December 27th, which was 56 days to expiration. If we move this forward to our first adjustment, that is January 16th. So so we basically sat in this position without doing anything for approximately 20 days. The market did end up moving up. We're drawn down a little bit because the market was moving up. It looks like there's also an implied volatility thing here, because a lot of times if we sit in it for 20 days and then hit our add point, a lot of times we won't be drawn down money. But we have a $15,000 exit loss trigger, so being down $1,000 is negligible. And we're running about minus 125 delta. If we look at our position here, you can see we've run outside the tent. It is time to make an adjustment. Now, one of the things I really like about this strategy is the adjustments are actually going to make us more negative delta, so we're taking on more upside risk. That gives us the ability, when you have a more normal market and the market shifts back, it gives us the ability to actually make money when the market runs through its normal cycles, and we can make money quite quickly. But anyway, right now, we've gone up to our add point, which is 1700. What we're going to do is we're going to add in what we call our second third, because this is entered in thirds. So our first third was our butterflies at 1660. Our second thirds are going to be butterflies at 1680. So essentially we are just adding in. This will increase our negative delta a little bit more. and it'll give us a position that looks like this. So we're back inside the tent. We're good if the market stalls. We are very good, or actually in better shape, if the market comes back than we would have been initially. And if we continue to go up, then we'll continue to scale into this position here. So it's January 16th. Let's go to our next adjustment. Friday, January 31st. So let's just go back a couple of days because that's a large amount of time. Let's go to January 28th. So what had ended up happening here is the market went up and then it pulled back, which is what we were expecting, right? That's what the market normally does. It goes up for a while, it pulls back a little bit. So normally it pulls back to somewhere around here, and then it usually starts to bounce again. So at this point here, we're up about $10,000, which is going to be 20% of our $50,000 planned capital. We currently have about $24,000 in the trade, so it's up almost 50% of 24,000, but we are going to get more in the trade, I believe, as we move along here. So here we are up $10,000. We're 24 days to expiration. Now, this is scheduled to be exited if the profit is over $5,000 at 21 days to expiration. And let's just click from day to day here since we're pretty close. Okay, this is what we look like on Wednesday. We're up about 11,000. Everything is going really well. We'll go to Thursday. Right, we're up about $10,000, almost $11,000 still, and it looks like we're probably going to take this off at around a $10,000 gain on the next day because our profit target drops down on the 21st. Now, this is one of those situations where we had a really big move, and the move was actually to the downside. If you look at the position, we're a little bit vulnerable to a downside move right now, and that's what happened. We get a 34-point down move in the Russell. That's a monster move for the Russell, and we were positioned poorly for that move, so we did draw down some. We drew down to 47.60. We are now 21 days to expiration, so we would take a $5,000 profit at this point. And some people may take this profit. This is relatively close to 5,000. It wouldn't be a terrible idea to do such a thing. But if we are going to stay in this, we have a rule shift now. The rule shift in the Bearish Butterfly, once we get out 21 days to expiration, is designed to just maximize your size and see if the market will just stay settled for a day or two and our profits come into the position and we can get out. So what we do here is we are to positive delta. We're generally going to want to cut this down a little bit. Notice we're way outside the tent here. We're way back here. We don't need to be in the tent. It's okay if we're not, as long as our delta numbers are in line and everything's in line. So generally, I'm going to cut this back a little bit from a delta range coming into expiration guidelines. So here what we did is we ended up adding in butterflies underneath here at 1640 and selling some of our butterflies at 1680. So you can see this happen here. You can see now we have our 10 contracts down at 1640, and we only have 8 contracts up here at 1680. It gives us a delta of 221. Even 250 was very reasonable for this, and it was actually acceptable when we could have left it alone. But one of the things that we're concerned about is we were very far outside the tent. So you can see here we're very far outside the tent. We do want to bring it a little bit closer to the price here. So we'll make this adjustment an adjustment like this coming into expiration. So I came in here, added 10 butterflies at the 1640 level, brings the tent back, and we dropped out a few 1680s to bring our delta down. Usually we like to be around the 200, 250 range on this position when we're 21 days to expiration going into the next day. So if we do go into the next day, we end up getting a 20-point bounce. And here's the really cool thing about this. I mean, you notice a lot of the profits get ripped out with our 34-point down move. When we make our adjustments and we do an up move, we're close enough to expiration here where we can gain money really quickly. And that's the objective of this strategy. If we get under 21 days to expiration and we still don't have a decent profit or an acceptable profit, the idea is to increase size and make our delta where we want it, and just see if we can get that 1 or 2 days of favorable price movement, get up our money, and pop out. So this case here, this move on this day put us up to $11,592 profit. That's what, about 23% off the top of my head. That's well over our $5,000 reduced profit target. So what we do is we exit the trade for a profit of about 23% in 38 days. Not bad at all. And that was the Bearish Butterfly trading strategy, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you can follow along with this and many other great options trading strategies as they unfold around weekly options trading for income webinars, and where you can also learn about upcoming winning trade presentations and our trading success blueprint. And perhaps best of all, you can get information on our free trading performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how you too can profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any questions you may have. Thank you, and we'll see you on the next winning trade.